Now it's time to kick things off with analysis of the important policy issues that will impact investment advisors in this new administration and new Congress. We have a lot to talk about today. I'm joined here by three policy experts who will help me unpack what's going on. My colleague Neil Simon, IAA Vice President of Government Relations. Hopefully you've met him at Advocacy Day, if not at these conferences. And I hope you will see him again at our virtual Advocacy Day, June 10th. Langston Emerson is a partner at Mindset DC, a bipartisan policy shop. He's a policy strategist and advocate with strong experience in financial services. Langston began his career in policy work on Capitol Hill, holding senior positions in the House and Senate. He was previously at a law firm and at the Federal Reserve Bank of New York. Rana Wright is partner, CAO, and general counsel of Harris Associates and principal executive officer and president of the Oakmark Funds. Among all of the responsibilities that these many titles bring, I can add to it that she's on the IAA Board of Governors and chair of our Legal and Regulatory Committee, which helps shape IAA policy. Rana's distinguished career also includes serving as chief legal officer for BofA Global Capital Management and partner at Reed Smith. Welcome to all of you. We're going to set the stage here with a discussion about the change in leadership, the folks who are critically important to setting the policy agenda. Let's start with the change in Hill leadership and what that means for investment advisors. And Neil, we'll start with you.
Thank you, Karen, and good morning, everyone. Delighted that you're here. House and Senate, not so many changes in the House in terms of the key folks that we deal with. Maxine Waters remains chair of the House Financial Services Committee. Brad Sherman, another Democrat from California, is chair of the key Capital Markets Subcommittee. And then finally, let me just mention one other subcommittee, which is the Diversity and Inclusion Subcommittee, chaired by Joyce Beatty. This was a subcommittee that only began in the last Congress, and I'm mentioning it because, as we'll be discussing a bit later, I am expecting that this D&I subcommittee may very well focus on the asset management industry sometime during this Congress. Of course, more significant change in the Senate, which of course changed hands. And the chair of the Senate Banking Committee had been Republican Mike Crapo from Idaho, and it is now Democrat Sherrod Brown from Ohio. This is a significant change. It's not only a change of parties, but it's a very significant change in philosophies. Senator Crapo was a conservative from a Western state. Sherrod Brown is a liberal, somewhat populist Democrat, and I am expecting there's going to be much more legislative activity in the Senate Banking Committee than there was under Mike Crapo, where, as was said, House Financial Services Committee bills went to die. So stay tuned. I think there's going to be a lot going on. Langston, you probably have something to add.
No, I think everything you said was absolutely right. I think that both in the House and Senate, though the Senate stayed the same as far as, or House stayed the same as far as leadership is concerned, there is much slimmer margins. And I think that there's going to be a lot of difficulty getting kind of hard or heavy legislation through Congress, both in the House and in the Senate, with a very clear focus on the upcoming elections in 2022, both in the House and in the Senate. So in particular with the 50-50 Senate, it will be very difficult. And I think leadership understands that in both houses or both chambers. I think there will be a large focus on urging and pressuring the Biden administration to do rulemaking from a unilateral perspective, understanding that legislation will be difficult to pass. So if there is any overarching or maybe anything worth underscoring, I think based on what you said, Neil, it's just that there's less likely to be a lot more legislation that has been difficult in the past that moves through Congress, but that does not mean that there won't be an urgent, some push and pressure on the agencies to do more.
Thank you, Langston. And actually, that is a perfect segue to Rana, because the agencies are already starting to discuss a lot of these issues. Rana, what is going on with the change in personnel at the SEC, and what do you expect?
Yeah, a lot, Karen, and I think you're absolutely right. The press is full of information, and the hardest part in prepping for this panel was trying to get it down to some hot topics. So, assuming a Gensler confirmation, I think we can see a regulatory agenda starting to take shape very soon. I think we will continue to see the extraordinary work of the staff and the commission focused on retail investors. From a more tactical and tangible perspective, something that we heard yesterday in the hearings that was quite encouraging was around e-delivery. Few words were said, highlight them, but they were impactful nonetheless. And that's the statement of let's embrace technology and move forward. So I think we'll see some movement in the e-delivery space. Another thing that was also highlighted in the Division of Examinations priorities this morning that we'll probably see is we can expect a revisiting of the 2019 Standard of Conduct package, which we all know was no small feat to complete, but also not without controversy. So you may recall that this package includes Reg BI, the new standard of conduct for BDs, the fiduciary interpretation for advisors, and Form CRS. Gensler and the two Democratic commissioners have concerns and with wanting it to be substantially strengthened. So we could see some work being done here, and whether to start from the beginning or reopen the rulemaking package, or whether to just kind of tweak what was already adopted is probably what we'll see, assuming just tweaking what's already there. No surprise, and what we'll talk about a little bit later is ESG, so that will continue to be a focus. Couple of other items, we may see less eagerness on the expansion of private markets. You'll recall the broader accredited investor definition passed under a prior administration might not have been as warmly embraced in the current environment. As a skilled technician of markets and products, we can expect to see some movement on blockchain technology, cryptocurrencies, and investments in cryptocurrencies. And the one that's highlighted the most is the possibility of seeing more on the enforcement front. It was noted in the hearings yesterday that obviously there will be just a focus on areas with the greatest problems. So to stop where I started, I think we can expect to see more transparency and more compliance in the name of investor protection.
Thanks, Rana. The change in personnel will really bring significant changes. And as you referenced yesterday at Gary Gensler's confirmation hearing, the transparency, there were a lot of themes around disclosure, political contribution spending disclosure, climate risk disclosure, diversity disclosure, private equity disclosure. That was definitely a theme at the confirmation hearing yesterday. So let's start with what's going on Capitol Hill right now, and obviously that's the stimulus package. It does not directly impact investment advisors, except to the extent that it's a precursor for anything else getting done, and it's taking up a lot of oxygen in the room. So Langston, why don't we start with you commenting on that?
Absolutely. Thanks, Karen. I think you're absolutely right. That is probably the biggest takeaway for the COVID relief package that they're working on now in the Senate as of today, is the fact that it's just taken up so much oxygen out of Congress, both chambers, and will continue to over the next few weeks in order to see it passed and at the president's desk by what they suspect and hope is by March 14th. But subsequent to that, or after they're done with that package, they're moving quickly to the next package, which will take much longer. And that package will focus a lot on infrastructure and recovery versus relief from COVID. So they're working on a larger package. Obviously, there's a desire to be bipartisan, but with the size of this package that we're hearing, nearing a $1.7, maybe $2 trillion, there's a likelihood that they may have to engage in reconciliation once again, and in order to move the package forward and get it to the president's desk. That's something that will start in earnest probably within the next month or so, but because they'll go through a different scenario and regular process, a regular order through committee activity and the like, the likelihood of that making it to the president's desk before August or September is slim. So it's going to be, I say all that to say that it will continue to take a lot of oxygen out of the room because over the next couple months, there will be a lot of work on the committee level, even committees of importance to IAA and its members, that will be focused a lot on what they could have put into that package. But with that said, there may be a lot of issues in thought because this will be a larger package that will focus on a lot of different things. Some of the things that were alluded to today that I know we're going to talk about more, including ESG, including racial justice and DEI efforts, those will be very well, I believe, and we're hearing that they will be part of the larger package. How that will pull in and how and what will it look like coming from the committees of importance to us is still to be determined. But they are having hearings now and introducing bills that are relevant to the membership here. So we can discuss that more. But I think outside of that infrastructure package, the committees are still going to have hearings. As you all know, the GameStop hearing was something that in the House side definitely took out a lot of oxygen, and it's not over. They're planning that the Financial Services Committee will hold 3 more hearings at the subcommittee level to really dig in and around issues around transparency, short selling, and the like. In the Senate, we'll focus on it, and the Senate Banking Committee will focus on it as well. So while it, again, may not necessarily come to a point where they're legislating on it, it is something that will definitely take up some hearing or committee time for both the House and the Senate. And those are big issues. And I know we're going to get into this quite a bit more, so I'll just hit on some hot topics that, I think Neil and we've all alluded to today is that moving forward in the Financial Services Committee in particular, and Neil talked about the Subcommittee on Diversity and Inclusion, which is the only subcommittee in Congress, and it falls within the Financial Services Committee. They will focus quite a bit on diversity and inclusion over the next month. They have 2 hearings that one is at a full committee level and the other is at the subcommittee level that will focus on racial justice and diversity and inclusion efforts within corporate entities. And I think that we've been hearing that within 2 weeks, they're going to request data from a host of different entities under the financial services umbrella. It's very similar to the letter that they sent out last year to about 45 or 47 depository institutions. This year, they're going to do it a little similarly, but it won't be just depository institutions. It will likely span to maybe insurance, asset management has been thought about, non-bank or depository or financial institutions, fintech, it could be the like. So there's we're still waiting to see who will get the letter, but I would not be surprised if a lot of the members were implicated. In that request will be for data about what they're doing inside of the company as far as diversity and inclusion initiatives, third-party vendor activity, as well as board diversity to the degree they're publicly traded.
That's a lot for all of us to digest. There's a lot going on. Thank you, Langston, and we're going to hit on some of these big themes in a little more in depth now. Before we go into that, I do want to remind folks that you can give us questions. We will try to answer them throughout the panel. They are anonymous, so feel free to ask us some questions. Let's turn to one of the biggest themes that you all alluded to, and that is climate change and ESG. It is already, the new administration is already focusing a lot on this issue. They've already named sort of climate change point persons, if you will, specialists to virtually all of the agencies. It's already taking shape. Langston, how is the climate risk issue going to shape up in Congress? What can we expect to see here?
Well, I would say in both banking and financial services committees in particular, they will be, it was made clear from both chairs, Chair Waters of Financial Services as well as Chair Brown in the Senate Banking Committee, that this will be integral of any activity that happens within the committee, in particular as they look to insert provisions or legislation into the broader infrastructure package. And I think that's important because this is not just an exercise that will live and die in a committee. It is something that they are looking to incorporate into something larger that can actually make it to the president's desk. And so that can look like a few different things. We know that there are some disclosure, climate disclosure bills that have been introduced by Congressman Caston and the House Committee, Financial Services Committee, as well as Elizabeth Warren in the Senate Banking Committee. Those bills will have been and will be reintroduced and likely be pushed to be included in the broader package, and that could be shifted over into potentially an infrastructure and recovery package in some way, shape, or form. They're having hearings on that now, and it will continue to. We've been told that they will have a markup in the Financial Services Committee probably within the next month or a month and a half. And it will include some of these climate disclosure bills in particular. I think the Caston bill is one that's very similar to the Warren bill that they introduced last year and passed, and I think they want to move forward on that again. So, and again, the one thing that I said earlier I think is important, Karen, is that a lot of these bills that they will introduce on the ESG front will likely make it past to committee, but maybe not to the House floor. But this is all in an effort to urge and work with the SEC to do more as well. So it's not necessarily passing for the sake of passing. These climate disclosures and determining materiality and things of that sort will be important as they work with the SEC to have things implemented. But as far as real meat on the bone, there are a couple bills that have a lot of support in the House and Senate and leadership supports as well. And I think disclosures for issuers and publicly traded companies as it relates to climate risk is very important. So I'll stop there and let you take over.
Thanks, Langston. And as you alluded to, I think a lot of the action is going to be at the SEC. Rana, could you share your view on what role the SEC will play and what will some of their first moves be?
Sure. As I was listening, also taking notes, right? A lot going on here, and this is a shift for us. And ESG and climate change are top of the list. And there's so much out in the press that you can take sound bites from to kind of see directionally from Acting Chair Lee where we're headed. So generally speaking, we can expect to see regulation coming, but we really need to focus in foundationally on what we mean when we're talking about these topics. Karen, you alluded to it, but it's worth emphasis again to say. Acting Chair Lee announced the SEC would revisit and update its 2010 guidance on climate risk disclosure for public companies. So we should all be thinking about taking a refresh there to see what's coming from the past that could be instructive. And the Commission is dedicating resources in the first senior policy advisor appointment for climate and ESG. So again, not much reading of the tea leaves there to understand something's coming. And so when I was thinking about how to scope how the Commission is thinking about this, there was a recent webinar where Lee stated that the Commission wants to create a more comprehensive framework that produces consistent, comparable, and reliable climate-related disclosures. It was echoed again in the hearings yesterday. When talking about ESG more generally, the exam staff has engaged in mini sweeps relating to ESG, and so some of the members may have gotten sweep requests and the like, and there have been deficiencies issued, which is complicated given where the regulation is. And so it's a reminder to say that your disclosure should it should say what you do. And so just to be sure we're sufficiently defining in our own shops what we mean and the framework we're operating under. Again, it's just emphasis. The SEC is clearly focused on the topic and is in information gathering mode. And there are a ton of resources available to people, especially when we're thinking about consistent terminology that's able to help us. AMAC, so the Asset Management Advisory Committee, included a presentation from its December 2020 meeting that's publicly available. And there are other white papers that talk about the topic. So I think there are resources out there, and we need to at least be able to say we can focus on it in our own shops, all recognizing that it's incredibly difficult to legislate.
Thank you, Rana. And as alluded to earlier, the SEC came out with its exam priorities. The Division of Examinations came out with its exam priorities this morning. It will be discussed later on in the conference, but one of the things they emphasized was exams related to climate risk. So that will obviously continue. The Acting Chair Lee has named personnel dedicated to climate risk related issues. And one has to believe that was coordinated or at least run by incoming Chair Gary Gensler, and that Commissioner Lee will continue to play an important role as this moves forward. In terms of other agencies, as I mentioned, the focus on climate is going to go across all agencies, including the Fed, the DOL, and Treasury. At the DOL, we expect Marty Walsh, the incoming Secretary of Labor, to focus on this soon, and he could be confirmed fairly soon, in the next week or two. He's going to have a lot on his plate. President Biden issued an executive order that directed agencies to conduct a review of rules that conflict with important national objectives, which includes climate change. That order specifically directed the DOL to review the financial factors in selecting plan investments rule. That rule prohibits consideration of non-economic factors in investment decision making. We opposed the proposed rule. The final rule took the ESG reference out of the rule text, but our concern remains that it could still chill ESG investing. And while not specifically directed to do so, the department may also review the recently adopted proxy voting rule, which also has an ESG impact. Those rules are currently in effect. We've asked the Department of Labor to take a non-enforcement position until the industry can figure out what the new rules mean for them and the new administration can review them. And this is all going to be discussed later on in more depth in the conference. But it's just an illustration of the focus on climate-related and ESG-related issues across the administration. Let's turn now to dive back deeply into an issue that Langston mentioned, and that's racial equity and DE&I. That is going to be the focus of policy efforts in this Congress. Langston already talked about potential hearings in this area. So, Rana, why don't I turn to you and ask what role you see the SEC playing here?
Sure. I'll start with, unfortunately, I don't know how much can be done. It's obviously top of mind for a lot of people, but again, consistent, I guess, with something I said a moment ago, it's hard to regulate. When we think about human capital, Reg SX had disclosure requirements, and we are seeing more corporate issuers update their disclosures from a human capital perspective. Clients are asking about it, which gets the attention of kind of resources and headcount for purposes of in the walls of how we communicate about these topics. The SEC's diversity and inclusion efforts are led by the Office of Minority and Women Inclusion, but all of the documentation and the requests are voluntary, and we know most people don't respond. And so OMWI just doesn't have the authority to mandate it. I wish there was more I can say here. It's clearly a focus, but I just don't know what gets done here.
Right, and the Asset Manager Advisory Committee may be making recommendations soon. Langston, do you have anything you'd like to jump in here with?
Yeah, I think it's a good point made about it's just being harder to regulate. I think what we do know is the Financial Services Committee in particular and Senate Banking were they had a difference of opinion of whether the information that should be disclosed to OMWI were voluntary or mandatory. And I think that's where they would want to start with legislation. If one of the pieces of legislation that they had discussed was to write legislation that would make it mandatory to submit the information to the OMWIs versus what is now just voluntary. And so that has been discussed. But I do think from a broad perspective, Karen, there are two areas of focus, for the Senate Banking Committee as well as the Financial Services Committee, and they communicated a lot on these issues because they are looking at legislation that will make it into a broader package, but it's going to focus on data disclosure, so a lot that we were discussing, and board diversity and corporate diversity. So those two issues are going to be the kind of larger areas of focus under which a lot of different things can fall. With the data disclosure that we discussed, within a couple of weeks, we'll see another batch of data requests, letters going out from the Financial Services Committee that again will ask corporate entities within the jurisdiction of the committee to submit information to the committee about its internal policies, initiatives, and diversity efforts, as well as what they do externally with the third-party vendors and on a corporate board level as well. But in addition to that, there will be a few bills introduced that were introduced in last Congress, and one which would require some disclosure on board diversity, not dissimilar from what we have seen with the NASDAQ proposal that was sent over to the SEC. And I think that is one that they are pressing on, and they were really happy to see what NASDAQ has done. I suspect we would like to see it, and I'd be curious as to where we think that's going to play out in the SEC and whether it would be approved or not. But from, those are the big ticket items, if you will, that they're looking at, the big focus areas under which, again, a few different types of legislation may fall. But I think that with next week, they have a hearing, I believe it's on the 23rd, which will, on the 18th, I'm sorry, March 18th, that will focus heavily on the data disclosure request that they send out. This is the Financial Services Committee. So from that point, moving forward, there will be a lot of action and activity within that committee, but also it will translate over into the Senate Banking Committee as well as they start to look at these issues. And from a conversation as recent as this morning, it will be happening in that committee as well.
And if I can just add,
go ahead.
Oh, I apologize. I was just saying that's March 18th, and then the next day, AMAC, which we've mentioned before, is likely to come out with its recommendations on the D&I front. This is something that IA is going to be looking at very hard. We recognize that the asset management industry just has to step up, and we really want to be part of that effort. So we're going to be involved in this legislation. We're going to be involved in the AMAC recommendations, and we'll certainly be communicating to all stakeholders in the asset management industry about these issues.
And Neil, the point I was going to make was just that the asset management part follows a lot of that stuff. So you'll have the recommendations coming down, but it is corporate issuers, NASDAQ. There was also some buzz about whether it would apply to mutual fund boards and the kind of board diversity rules, but none of that is really front and center yet. But that's all the debate and the discussion, and so it will obviously pick up with this administration.
Absolutely, and I just want to echo what Neil said about how important it is to the IAA and how closely we will be focusing on this issue to make positive change in our industry as well. Before we go on to the next topic, we got a question from the audience on ESG and climate change. Noted that the EU regulations go into effect shortly, and whether we anticipate the SEC adopting a similar approach. My quick take is we've made it very clear to the SEC, and I know others have as well, that the EU kind of put the cart before the horse in dealing with asset manager disclosure ahead of issuer disclosure. And we would hope that the SEC would focus first on issuer disclosure. Rana, I don't know if you want to add to that.
The only thing that I would add is that the SEC, via Acting Chair Lee, kind of said recently it will be guidance, right? There's a lot there, and it will be instructive, but much more fact-gathering phase and principles-based, but leveraging the work that has been done in the EU, not as determinative, but as informative.
Thanks, Rana. Turning to another critical topic, fiduciary duty. We touched on this a little at the beginning. There's been a lot of speculation that the newly constituted SEC might want to revisit the standard of conduct package. Rana, you noted that it's likely that the SEC will take another look at it. We think it's probably more likely that the SEC will make changes to the existing framework rather than going back to the drawing board. What do you see happening, more specifically in this area?
So, Karen, it's a complex landscape that remains complex, where you've got, broker-dealers starting to getting examined under Reg BI. You've got the DOL landscape, and then the states kind of doing their own thing. So from that perspective, I do expect interpretive issues and FAQs to come out where appropriate through the exams. Again, this morning when the exam priorities came out, there was obviously going to be some more outreach done here. I assume that Gail Bernstein, so the IAA General Counsel, will have a more in-depth conversation about the exam priorities and what can come from there. But there was a roundtable in October, just kind of, again, fact gathering. There was already noted issues with Form CRS. So from a tangible perspective, I think we need to kind of get all of that input together and figure out a way forward. And that's what I think the new administration will be looking for, and trying to reconcile what the states are doing too. You've got Massachusetts, who adopted a rule last year that's similar to Reg BI, but differs in some significant ways, including in Massachusetts to create an ongoing fiduciary duty for broker-dealers, and then Oregon is now considering some legislation. So it's all over the map, and maybe you might want to talk about even where the DOL is in this regard.
Absolutely. The DOL's fiduciary rule class exemption was allowed to go into effect, to the surprise of some people, and the DOL announced that it would issue related guidance, whatever that means. In fact, incoming Secretary Marty Walsh told Congress that he would prioritize a reexamination of the rule. It's likely that they, rather than starting from scratch, they'll build on and reinforce interpretations in the existing exemption that they allowed to go into effect, including with respect to rollovers. It's likely that there'll be coordination with the SEC. I see both, in my 2 cents, both the SEC and the DOL looking to build on and strengthen interpretations and guidance under both of these rules, perhaps defining terms like best interest and using the enforcement regime to make sure that there's a significant change and positive reinforcement, shall we say, along these lines. Again, my 2 cents is, neither agency will go back to the drawing board, but they'll build on the existing framework.
Yeah.
Langston, do you see anything happening on Capitol Hill with respect to fiduciary duty or Reg BI?
I don't think there will be much legislation. I think there will be hearings in the relevant committees. I think there will be some, maybe even letters from certain members to put pressure on the agencies to look into it and to activate on it. But as far as actual legislation, I mean, I could not say and would not say there may not be a bill introduced in and around these issues, but as far as them being included or making it to the president's desk for signature, I'm very skeptical and highly doubtful.
It will be, yes. Yeah, thank you, Langston. So more of a showcase effort rather than legislation and action at the agencies, really.
Right. That's right.
Let's turn to another blast from the past, if you will. We've been talking about fiduciary for decades. We've been talking about financial stability since Dodd-Frank. The past administration didn't focus too much on this. FSOC was not active, the Financial Stability Oversight Council. We certainly expect that to change in this administration. Langston, turning back to you, what kinds of financial stability issues will Congress focus on? Are we going to see a return to a focus on non-bank SIFIs, systemically important financial institutions?
Yes. Yeah, I think that is clear. I think there will be hearings to look at this from a broader perspective beyond banks, but non-banks and other, frankly, I think technology as well. Tech companies may be a concern. And climate change will be looked at as being an actual financial stability risk, and then how they look at that. And we understand that the different from FSOC's perspective as well as from Senate Banking Committee, they consider it to be an issue that could cause financial risks, and it could be, an issue to, in some way, shape, or form, look at and assess as to any necessary or need from the FSOC, and how should they approach that as far as exams are concerned, or even just assessing, stability for the country. I would also look at issues around. I go back to this, and I think it's become a theme of this discussion, but issues around racial and economic justice. I mean, they do consider whether, and this has come up quite a few times, there will be consideration of that as being, equity as being an issue that needs to be discussed, and from a financial stability, from an economy or economic stability perspective, is something that they will consider. Now, whether FSOC considers it such is different from where certain members of Congress may be. I think from a market stability perspective and a market structure issue from writ large, I think the GameStop hearing has highlighted and illuminated a lot of issues in that space. And from what we understand, is especially as we've seen more recently, has been in the press about, it's not just GameStop now, is Rocket or Quicken Loans is another entity that has kind of fallen prey, if you will, to the kind of GameStop style, gamification, if you will. And so that, from a market stability and market structure issue, those will be assessed and now highlighted even more so in the relevant committees and as they look at financial stability. But I think I say those few things, but I believe, Karen, that they could be, from a financial stability perspective, looked at in FSOC, dealt with on a committee level, but also legislated and included in a larger infrastructure package. There is a desire to include climate issues, sustainability issues, legislation in a broader infrastructure package as they look at recovery. And they believe that financial stability is part of that, market stability is part of that. And so they're looking at climate, they're looking at racial inequity as part of that larger package. So you have the issue of FSOC and the agencies looking at financial stability, but you also have Congress looking at it from lenses that are relevant to their committee and jurisdiction, but also from the broader perspective of looking at legislating on it through a recovery, and what could, from sustaining recovery for the long term, would include broader and better infrastructure, will include climate change assessment and legislation, as well as racial and economic justice.
And if I can just add, the FSOC came up during Gensler's confirmation hearing, and he embraced an activities-based approach. But let me suggest that even for those asset managers that are not behemoths, they need to be concerned about this. The type of prudential regulation that would be imposed if a non-bank, an asset manager, is designated a SIFI, systemically important financial institution, will trickle down. That's just the nature of regulation, and it could. So this is something that we will certainly be involved in and watching very, very closely.
That's right, Neil. Rana, the SEC has already actually taken some action with respect to financial stability and systemic risk, including money markets.
Yeah.
Can you share what's going on there?
Sure. The main 2 points that I would have focused on in this section was the SIFI designation, which I think will resurface, and it's worth emphasis, but also another bite at the mutual money market fund regulatory apple, if you will. Money funds are near and dear to my heart. I was a line lawyer for a money fund complex. So 2010, 2014, and now 2021. So a couple of high-level thoughts on the proposed money market reform. The SEC earlier in February published a request for comment on potential reforms to improve the resiliency of money market funds. And that request follows a December 2020 report from the President's Working Group that highlighted structural vulnerabilities in prime and tax-exempt money market funds, which were exposed as a result of the events of March 2020. So these market events obviously lead to money fund reform. The report, at a high level, the report notes that these events occurred despite the reforms in 2010 and 2014. And the report doesn't address specific reform measures, but it highlights potential reforms that will be familiar to most of the participants. Removal of the tie between the liquidity fee and gate thresholds, conditions for imposing redemption gates, liquidity management changes, swing pricing will be front and center again, and capital buffer requirements. So more to watch in this space for reform.
Thank you, Rana. There's definitely a lot going on and a lot to unpack there. Let's turn back to Capitol Hill now. Tax and retirement issues are critically important to our members, and we, the IA, have been very active in these areas. There's been a lot of talk already of financial transaction tax, billionaire wealth tax, baby bonds, Retirement Secure Act 2.0. There's a lot going on. Neil, why don't we start with you on the retirement front?
Sure. Way back in the first session of the last Congress, the Secure Act was passed. And those of us that are strongly in favor of doing more in the retirement area were very optimistic it was going to be the first of 2 or 3 bills in that Congress. Well, that didn't happen. Some other issues cropped up, and of course, it became a hyper-partisan atmosphere. So, although initially there was a lot of bipartisan spirit in favor of this legislation, it didn't come to pass. I do think there is going to be retirement legislation in this Congress. And in fact, at the very end of the last Congress, Ways and Means Chairman Richie Neal and the ranking minority member, Kevin Brady from Texas, introduced what is referred to as Secure Act 2.0, not because they thought it was going to go anywhere in the final days of the last Congress, just to get the marker in, to put folks on notice. They're going to be pushing that bill. I think it will happen. There's interest in the Senate also. You have Ben Cardin, Senator Cardin from Maryland, and Rob Portman from Ohio interested in this, as well as the chair of the Senate Finance Committee, Chuck Grassley. And there are a couple of things that we are going to be looked for and are advocating already. More incentives for employees to participate in employer plans. Further increasing the age for required minimum distributions. It was moved from 72 to 75, but let's push it up further. Expanding investment flexibility for 403B plan sponsors, including allowing them to invest in CITs, and of course, e-delivery. It's implicated, it's important, it's time. Prospective SEC Chair Gensler at the hearing gave some tentative support for it, and we will be plumbing just how far that can go. But I am optimistic that we are going to see further retirement savings reform in action. This is one area, and there aren't many, where it may be possible to get 60 votes in the Senate. So this would not have to be done through budget reconciliation. That requires only 51 vote, 50 Democrats and VP Harris to avoid a filibuster. You need 60 votes, and I think there will be bipartisan support for this measure.
Thanks, Neil. Turning to an issue where I think there will be less bipartisan support. Langston, let's talk about tax. Is the financial transaction tax for real? What's likely to happen on the Hill with tax issues?
Well, I would say from the start, it's not likely to be a large tax bill that would kind of be an overhaul of the TCJA. I think that there will be probably a large tax measure that will be included potentially as reconciliation in the infrastructure package to offset some of the cost of the bill. And that is under discussion right now, how much would need to be paid for, whether it's 30% of the overall cost, 40 or what have you. I think that's important, Karen, because that will dictate and determine how much money needs to be raised and how much money needs to be used to offset some of the programs and provisions in the bill. So as it relates to that, there are some low-hanging for some, and maybe even from the progressive community, low-hanging fruit that could be addressed. Financial transaction tax is one, carried interest is another. Always looking at increasing the corporate rate. There's been discussion around increasing capital gains as well. All of those capital gains probably would raise a substantial amount of money, but has a lot of pushback even from some Democrats as well. So a lot of these issues are perennial issues that come up quite a bit here in the financial transaction tax. I'm sure we all have seen and heard in different iterations and from different members, from on a variety of years throughout, the several sessions in Congress. And it is something that will likely come back, including the recently introduced the uber wealthy tax, if you will, from Senator Warren, will likely be advocated and pushed forward in this broader tax bill. So, so I think from a tax perspective, where you do see that is occurring is really to offset some of the packages, or that some of the provisions in the package that they need in order to pass. So I think there are real risks. There are groups mobilizing right now to activate and advocate on behalf of or in opposition to some of the issues in like the financial transaction tax or like the increase in corporate or rate or capital gains rate. I think one other thing that should be mentioned is the minimum wage debate. So that is something that while it will not likely make it into this package, the COVID relief package, when they look at infrastructure, there are some Democrats in particular who are floating the idea of imposing higher taxes on companies that don't adequately pay workers. Now, how that is actually put in language, legislative language, and agreed to is TBD, but I think it is worth knowing because there are a lot of upset and irritated Democrats, at least, that we're pretty upset for not seeing it in this package. So either it passes in something that's standalone or they make a really hard push for it moving forward. So I think that's important as well as we move forward, because that may come to fruition as a tax, and something that hasn't been done before. And so that's kind of the broader perspective. I mean, there's definitely going to be, issues, I think, credits for climate and for carbon capture and the things of the like. I mean, these are perennial issues that I think they would look for in the broader package and the infrastructure package as well. But I think the ones that I have talked about are the bigger ticket items that tend to raise more money that also are highly controversial, not just with Democrats and Republicans, but in the Democratic caucus writ large. So though they are on the table, I think there's a lot of debate around whether they will be included. But it's worth advocating and being in front of the members and to let them know that this is a problem for the industry.
Right. We're obviously opposing the financial transaction tax strongly. We have and we will. So,
yeah.
And I think you touched on this, but we just got an audience question. How are the investor retiree benefits going to be paid for in the Secure Act 2.0? I'll throw that to either of you.
Let me try that one. And it's a real sensitive issue because the Secure Act had a lot of very favorable provisions, but the pay for was eliminating the stretch IRA, that tax planning technique, and that hurt. We don't know what the proposed pay for will be in the Secure Act 2.0, and it's something we're going to have to watch closely. I don't think it's going to be a financial transaction tax, but we simply don't know what it will be. So stay tuned, be close, come participate in our Advisor Advocacy Day on June 10th. We're going to be talking a lot of tax. We're going to be opposing the financial transaction tax, and we're going to be pushing for advisory fee deductibility then. But stay closely in touch with us on this one, please.
Yeah, and question from the audience, will the IAA take a position on the financial transaction tax? Yes, we will oppose it. We have, and we will oppose it. Lightning round, we have 2 minutes left. I want to touch on an audience question that we were going to, I think, discuss anyway. Rana, there have been executive orders, about freezing regulation. What is happening with the advertising/marketing rule? Not been published in the Federal Register. What's going on with that?
Yeah, so in the lightning round, right, the soundbite, the marketing rule, which doesn't directly impact 40 Act funds, will be delayed, but practically speaking, I think the rule will go forward. Funds are kind of locked in for valuation and derivatives. So there was a flurry of activity, as we all know, in Q4, and it kept us all busy. But there's no indication that there will be any more delay for derivatives rule or valuation, and planning for full compliance by August 2022 for derivatives, and valuation September 8th, 2022.
So marketing rule, we think still going to go ahead.
We do. Delayed, but still going ahead. And as of today, because I was checking this morning to make sure my information wasn't dated, still not published.
All right. We have less than a minute left. I want to take on active passive real quick. This issue pops up a lot in retirement, in the retirement legislation. Policymakers putting their finger on the scale in favor of passive and embedding that in legislation. We, the IAA, are very much in favor of a more balanced narrative. We have an active managers council that very much promotes a balanced narrative that both active and passive, have important roles to play for investors, and policymakers should not put their finger on the scale one way or the other. We've been successful to date in keeping some of those scale moves out of retirement legislation. Rana, we've also recently taken action on the regulatory front. Can you talk for a few seconds on the Hart-Scott-Rodino Act?
Sure, I'm in the weeds on this one, so a few seconds. This might have slipped past some people because it was the FTC and the DOJ. IAA wrote a fantastic comment letter which sets the stage for the issue, but it could cause serious aggregation concerns and restrictions on investing client capital, which is no one's intent, especially when there's no anti-competitive concern. So this is one where I'll just also say and plug the Legal and Regulatory Committee. There is so much going on that it's really important to use the working groups that are established by the IAA, content rich always, but an opportunity to get together with your peers and work through these. We saw a risk alert early, middle of last year talking about compliance resources and the strain. So please use the resources available, and the comment letters are all on the website.
Thank you, Rana, and thank you, Langston and Neil. Very much appreciate your sharing your insights with us on a lot of meaty issues as we start this new administration.